So when you cross that number, the market stops asking, is this inflationary? And starts asking, is this stagflationary? And that is a very different question with very different implications. And this wasn't just the US, mind you. There was a global bond sell-off, which is why this really is big news. The 30-year in the UK surged 20 basis points above 5.8%. That's the highest since 1998 because markets are bracing for a leadership challenge to Keir Starmer, and the UK has a lot of fiscal problems. Japan's 30-year touched 4% for the first time, which reflects growing alarm about Tokyo's financial trajectory. Yields climbed in Germany, Spain, Australia. So the G7 finance chiefs are all sitting around discussing the sell-off and what to do. And the drivers do differ across the countries, but the threat is the same. So, as Barclays put it, inflation resurgence adds to the woes of an already battered bond market. So bonds no longer function as an equity hedge when inflation becomes the dominant risk. Like JPMorgan said flat out that the firm now prefers real estate, instead of bonds as a defensive position. That is a significant statement from one of the largest asset managers on the planet. RBC Capital Markets said if the 10-year hits 5%, historically, that's the level that compresses equity multiples. This means that the stock market would have to reprice, which brings us to the stock market melt-up.